Hello everyone, welcome back to All Financial Discussion channel. For this video, I'd like to kickstart the discussion on REIT investment. This video, I'm going to explain why REIT investment, especially in Singapore, become very attractive when interest rate actually cut. So this will be the first objective. On my next objective, I'm going to discuss the various types of REITs. For example, we have the retail, office, industry, hospitality, healthcare, diversified, and the specialized REITs. Okay, so this will be my second objective. Guys, if you're keen to know more about financial discussion, please see the playlist under the description. Over there, you will be able to find a series of discussion on financial discussion. Before I continue, guys, I'd like to urge you guys to help me by like this video. When more of you guys actually help me to press the like button, this video will have a better chances to reach out to a larger audience. So guys, help me press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer, I am not a licensed financial advisor. The content in this video is for entertainment and education purpose only and should not be considered financial advice. In this video, I'm simply showing you what I may be doing. Please conduct your own independent research and consult a professional if needed before you commit to an investment. Never invest more than you are willing to lose, and always be sure to read the fine print and the terms and conditions before you commit to an investment. With this, let's kickstart today's discussion. Okay, so what happened here is when interest rate cut, what will happen to the risk investment? Okay, so there is a very high chance that the Fed will actually cut the interest rate. As you can see from this CME group over here, you can see that 29th of October, there will be a strong chance to have a 0.25 rate cut. As you can see from here and versus here, you can see that we have close to 99% who have a 0.25% of rate cut as compared to the remain unchanged. So therefore, I think that, or maybe I should say that I strongly believe that the interest rate will reduce during the October Fed meeting. So what happened here is basically when interest rate cut, so this makes REITs more attractive to investor. Why? So firstly, you just imagine this as a giant seesaw. So when interest rate actually go down, the relative appeal of yield generating asset like REITs actually goes up. So which I will further explain why. So this is the so-called the reason that you need to understand. When interest rate actually reduce, very high chance the risks will go up, which I'm going to explain why. So basically the yield change, basically this is the most important why risks will go out when actually interest rate actually cut. So in Singapore, we are actually monitored by MAS. So MAS actually is the monetary policy. Let's say, most likely MAS will follow the Fed. When Fed actually reduce the interest rate, MAS most likely will also ease the monetary policy, and typically, this will lead to lower interest rate. This in turn reduce the returns on conservative investment such as Singapore Government Securities bonds, as well as the interest rates offered on saving accounts and fixed deposit. What happened here is basically, imagine this, when Fed cut the interest rate, most likely MAS will also follow. When this actually happen, this actually reduce the return when you actually invest in Singapore bonds, or on the other hand also, when you actually put the money into your saving account and fixed deposit, the interest rate reduce, the chances of your return also reduce. Imagine the latest Singapore Government Security 10 years bond is yielding 3%. A blue chip REITs yield 4%, might not seem much riskier for just 1% extra return. However, if the SGS bond yield drop to 1.5%, then with the same REITs now offer a 2.5 premium, then this will be very attractive. Earlier on, you can see that yield of REITs is just 4%, which is 1% better than bond. But we know that bond in Singapore, which is very safe, so probably we will not go to so-called invest into REITs since just a 1% difference. However, when bonds further reduce to 1.5%, and now having the same REIT return of 2.5%, this can be very attractive. Okay, so basically with this suddenly made the REITs dividends yield look far more attractive, pulling investor money away from the safe bonds and into the property sector in search of higher income. Okay, so this is actually the first and the most important reason. Next, okay, so another factor here is because REITs actually offer very attractive dividend. Why? Okay, so REITs are required by law to pay out at least 90% of their taxable income to shareholders as dividends. This makes them inherent high-yielding investment. In short, the lower the government bond go, the more attractive and valuable stable REITs dividends actually become to investor. Okay, so like I mentioned earlier on, there is very strong chance that Fed will cut the interest rate. So therefore, I strongly believe that MAS will also cut their interest rate. So therefore, the bonds will not be that attractive anymore. So therefore, the investor will go for a higher yield, and therefore a stable REITs in dividends actually become very attractive to investor. Next, okay, so why there will be a cheaper debts and higher property value when the interest rate actually cut? When we actually cut the interest rate, we actually has a lower borrowing cost. The real estate is a capital intensive business. REITs constantly borrow money to acquire new properties, develop projects, or refinance existing debt. When interest rates fall, their cost of borrowing actually decrease. This boosts their profitability because their interest rate expenditure also go down, leaving more money to distribute as dividend. Next is also on the higher valuation. Okay, so the value of commercial real estate is often calculated using a metric called the capitalization rate. Okay, you can see the formula is over here. Okay, so this is the formula to calculate the capitalization rate. From here, you can see that it will be net operating income over the value. Okay, so without getting too technical, okay, the cap rate is actually inverse proportional to value. Okay, so this is actually inverse proportional. So as interest rate fall, okay, the cap rate actually become compressed. Okay, which means that when interest rate fall, the capitalization rate also fall. So when this thing actually fall, you can see that your value actually increase, right? From this simple formula. Okay, so therefore this is what it means, which led to an increase in the appraisal value of the property the REITs own. This made the REIT portfolio and therefore its share price more valuable. Okay, so in short, when interest rate drop, capitalization rate also drop. And from this equation, you can see that the value of the property is inverse proportional with the capitalization rate. So therefore, when capitalization rate actually drop, you can see that the value actually increase. Once the property value actually increase, this will make REITs very attractive. So therefore, most likely the share price will increase and there will be more dividend to distribute to the investor. Third reason, okay, because of the economic simulation effect. Okay, so both to the economy. Okay, MAS actually cut rate to simulate a sluggish economy. Okay, cheaper borrowing encourage business to expand and consumer to spend. Okay, for example, the stronger real estate fundamental is for REIT. Okay, so basically you can see that REIT, we have retail, we have industry, we have office, and we also have the resident REITs. Okay, so the retail, okay, consumer might shop more, okay, because the interest rate reduce. Okay, so it will be more attractive to so-called to borrow to loan. So therefore, there will be a strong chance that the consumer may shop more because this actually will benefit the mall and shopping center. Industry REITs, when we actually reduce the interest rate, okay, so the cost to borrow also reduce. So therefore, this actually will increase the economic activity. Okay, means that there will be more demand for warehouse since it's cheaper to borrow and cheaper for us to expand. So therefore, there will be a stronger demand for warehouse and logistics space. Office REIT, business may be more likely to lease new office as they grow. Because in order to stimulate the economy, we easier and better to borrow. Business may consider to expand, and when they actually expand, they will lease new office. So this is another reason. Residence rate, a stronger job market actually helps people afford rent. So basically, when a company or when a country, basically will be strong, when they actually reduce the interest rate, a lot of so-called labor actually travel to this company to work. So when this actually happen, the rental actually become more attractive because we are able to command a higher rental, and therefore this also will be reducing the so-called vacancy rate. So this is another reason why reduce the interest rate may benefit the REITs. So this improve the economic outlook suggests that REITs will be able to increase their rental income in the future, making them more profitable. Next, will be the search for income, in a low yield world. As I mentioned earlier on, when interest rate reduce, the bond also reduce, and therefore people need to search for a better yield. So in a low interest rate environment, investors who depend on investment income, such as those who actually retire, they found that the payout from their Singapore bonds and their fixed deposit are not longer sufficient. So this actually forced them to search for a higher yield. So therefore they often move their saving into riskier asset. Singapore REITs, known as their reliable and attractive dividends, become a primary destination for this capital. This is a key reason why Singapore REITs like CapitaLand, Integrated Commercial Trust, and Mapletree's Logistic Trust become particularly popular with income-seeking investors during such period. So this is the reason why, when bond actually reduce, the return from the bonds actually reduce, people like those who actually retire, they need to sustain their lifestyle. So they actually go for a riskier asset. So for example, Singapore REITs being very so-called safe, so therefore there will be a high chance that they will actually try out on this Singapore REITs here. So guys, before I continue, again, if you have learned something from this video, urge you to help me by like this video and subscribe to this channel. Once again, thank you so much for strong support. Let's quickly come to the types of different REITs here. The Singapore REITs is one of the largest and most diversified in Asia, offering investor exposure to a wide range of real estate assets, both local and globally. So one thing I want to remind, I always emphasize this, please diversify your risk. I'm not suggesting you guys to go for REITs, but if you plan to invest onto REITs, make sure you diversify your risk. From here, you can see that there are 7 possible REITs: retail, office, industry, hospitality, healthcare, diversified, and specialized. There will be some that actually overlap, but one key thing, always diversify your risk. So this is the reason why. So I also want to emphasize, I'm not suggesting you guys to invest into REITs. But if you decide to invest into REITs, please take a close look on this video in order to diversify your investment risk. So this is the primary way investor and market actually categorize the Singapore REITs. It based on the type of property the REITs actually invest in. Let's come to the retail. So these REITs own and operate shopping malls and retail center. So where is their primary source of income? Rental income from retail tenant. So imagine this, when interest rate cut, basically people would like to shop more, and when they actually shop more, there will be a high chances that you will be able to collect more rental from the retail tenant. So basically this is why retail REITs may benefit when interest rate actually cut. So the example such as CapitaLand Integrated Commercial Trust. So this is one of the biggest so-called REITs in Singapore. So basically they owns iconic mall like Plaza Singapura, Junction 8, as well as the commercial asset. So next will be the Fraser Centrepoint Trust. So they actually focus on suburban mall like Causeway Point, North Point City, and Waterway Point. So basically this is for the Fraser Centrepoint Trust. Next will be on the Mapletree's Pan Asia Commercial Trust. Okay, so basically they own asset like VivoCity and Festival Walk, which is at Hong Kong. Okay, so basically in short, okay, you can see that there are actually three types of retail REITs for you to choose. Next will be on the office REITs. Okay, so these REITs invest in office buildings and business park. Okay, so where is their primary source of income? Okay, so this is important, okay, so that you understand the relationship. Again, when interest rate cut, okay, this make business expansion much more attractive, and people will go to look for a bigger space, which means that they will lease a bigger office space over here. So from here, you can see that the rental income from the corporate tenant will be increased because they go for a larger space, and therefore there will be lesser chance that there will be a so-called vacate, so-called building, etc. So basically, this is the key example of office REIT. Okay, again, on this capital land integrated commercial trust, beside on retail, they also have office. Okay, so basically, this is actually some form of overlapping. Okay, so also a major office owner with building like Capita Green. Okay, come to the capital REITs. Okay, so they own high quality office asset in key city like Singapore. Okay, for example, the Marina Bay Financial Center is owned by Capital, and also they have office in Sydney and also Seoul. Suntec City REITs. Okay, so basically they own a mix of office and retail space within the Suntec Singapore complex. So therefore, under the office REIT, you can see that again there are actually three choices: Capital Land Integrated Commercial Trust, Keppel REITs, and Suntec REITs that you can actually choose to invest. Next will be industry REITs. Okay, so this is a broader category that include various types of industry properties. Coming to the subcategories, we have the logistic and warehouse. Okay, we have nowadays, we have modern warehouse for storage and distribution. Okay, in terms of the business park and high-spec industry building, we have tech-focused, high-quality space. We also have the data center, which is the specialized facilities housing IT server. Okay, so coming to the example of industry REIT, we have the Mapletree's Logistic Trust, okay, Ascendas REITs, and also the Keppel DC REITs. Okay, so later on you will see that Keppel DC REITs, in fact, is something that is very new. Okay, so they are the first leased data center REITs in Asia. Okay, so basically they potentially going to have a global portfolio, but over here you can see that they are actually doing data center, and this actually become a so-called a REIT also. Okay, so this Ascendas REITs, they are one of the largest with a diversified portfolio of business park, logistic property, and data center in Singapore, US, and also Europe. Okay, so basically this is for the industry REIT. Again, I give you three examples. Okay, the Mapletree's Logistic Trust, Ascendas REITs, and Keppel DC REITs. Next, coming to the hospitality REITs. Okay, so this REITs own hotel, okay, service residence, and other accommodation asset. Okay, so basically the primary source of income, okay, basically from the room. Okay, when people actually go to hotel, okay, basically they have 1 night or 2 night stay or even 3 night stay. So the revenue come from the so-called room, which is often variable and linked to tourism and business travel trend. Okay, again, you can imagine when interest rate reduce, many people will travel here because it will be much more so-called worth in terms for tourists because the value actually reduce. So therefore, tourism and business travel actually will most likely go up. So again, there will be three examples: Capital Lands Escort Trust, Far East Hospitality Trust, and CDL Hospitality Trust. Okay, so basically for Capital, this is a global hospitality trust with serve residents, rental housing, and hotel. As for Far East, they own a portfolio of hotels and service residents in Singapore. For CDL, they actually own hotels in Singapore, Middle East, New Zealand, and also UK. Okay, so again, for hospitality REIT, you actually has three possible choices. Next, on the healthcare. Okay, so this REIT investment in real estate relate to the healthcare sector, such as hospital, nursing home, and medical center. Okay, why I recommend this? Okay, so because okay, regardless of the so-called the economy, most of the time, healthcare REITs is actually very resilient. Okay, so because no matter how, no matter whether the economy is good or bad, definitely there were people visiting the hospital, etc. So therefore, the primary source of income will be very stable. Okay, so this is for long-term rental income from the healthcare operators. Again, I'm going to have two examples. The first REIT, which is primary owned hospital in Indonesia. Okay, so we also have the Parkway Life REITs. Okay, so they own hospital in Singapore, for example, the Mount E, Grand Eagle, etc. And they also have medical properties in Japan. Okay, so from here, healthcare REITs, I actually have two examples for you. Next, in terms of the diversified REITs, which means that more than one. Okay, so these REITs hold a mixture of two or more of the above property types. Okay, so this diversification can help to reduce the risk. Okay, so earlier on, I did mention most of them. In fact, all three I mentioned. Okay, but from here you can see that all these three, they actually hold both retail and office. Okay, majority of them actually hold both the retail and office. So basically, this will be good because you diversify your risk. So anything happen, let's say to retail, you also have the office to back you out. So for the diversity REITs, we have the Maple Trees, Pan Asia Commercial Trust, Suntex REIT, Capital Land Integrated Commercial Trust. So again, on the diversified REITs, I actually have three examples for you to choose at. Next, coming to the specialized REIT. So basically this is a growing category. So this REITs focus on unique niche property type. One of the example will be the EC World REITs. They actually focus on specialized logistic and industry properties in China. For example, they take care of the port logistic, e-commercial logistic. So basically this is still under review. But for digital core REITs, such as Capital DC REITs, this is actually available. So this Capital DC REITs is actually very encouraging based on existing data. So therefore, these are so-called lumped under the specialized REIT, which is a growing category. Last but not least, I put all this into a table for you to understand in one glance. So again, there are 7 types of REITs: retail, office, industry, hospitality, healthcare, diversified, and specialized. And you can see that what are their primary assets. So retail is strongly linked to shopping mall. Office definitely will be office building. They rent the office for their tenant. So that's how they make the money. Same for the industry. So they will be so-called renting up their warehouse, their business park, etc. Hospitality will be mainly for tourism. They have hotel. They also have service residents. For healthcare, so basically this is much more resilient against any economic downfall. So because their primary asset is actually hospital and clinic. Diversified is simply more than one. So basically we may have 2 possible primary asset. Same for the specialized. Specialized will be one concentration area. And again, I have also explained the key driver of performance and also some of the example of the Singapore REITs. With this, I like to end my discussion. But I like to say this, I'm not suggesting you guys to invest into REITs. But if you have so-called done your own research and have decided to invest into REITs, most important, try to diversify your risk. As you can see from here, there is no just one type. So instead of invest just one type of risk, you can consider to spread out your risk to different risk types in order to diversify your risk. With this, that's all I have for your discussion today. Thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.